The board is set, the entry gate is open, and on a Monday, that matters more than people realize. Welcome to the VIXShield Daily Market Summary, Market Close Recap for Monday, April 20th, 2026. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. Today we are walking through what actually happened, how the market opened this new week, where volatility landed, and what our entry framework had to say about it. We have got a full week ahead with some significant catalysts on the calendar. Let's get into it. The S&P 500 closed today at 7,109. That is a fractional pullback, down roughly 0.25% on the session. Not a dramatic move, but meaningful in context. We came into this week at record high territory, and the market spent today digesting that altitude. Think of it like a climber pausing at a ledge, not retreating, just catching breath. The CBOE Volatility Index, the VIX, settled at 19.13. That is up from 18.36 on Friday, a move of about 4.2% in a single session, modest on its own. But here is the detail that earns attention. The VIX is now running about 5% above its 5-day moving average, which sits at 18.22. When the VIX climbs above its own short-term average like that, it is a signal that fear is quietly accumulating, not spiking, not alarming, but building. The term structure today is in contango. Let me explain what that means for income traders, because it matters. Contango simply means that longer-dated volatility, what the market expects 3 months from now, is priced higher than near-term volatility. The 3-month VIX measure, known as the VXV, came in at 21.37 today, giving us a spread of about 2.25 points above the spot VIX. That is a normal, healthy structure. It tells us the market is not panicking today. It is calm, near-term, with modest caution priced further out. For iron Condor traders, contango is the friendly environment. It means VIX futures carry is working in your favor. Now the broader picture, the dollar index was essentially flat today, off a fraction of a percent, barely worth noting. Gold added about 0.7%, a mild haven bid, but nothing dramatic. Crude oil, however, was the standout, down nearly 5% on the session. That is a meaningful drop, and it points toward demand concerns, or easing geopolitical pressure in energy markets. Bitcoin climbed about 1.5%, while Ethereum slipped roughly 0.2%. A mixed crypto session that neither confirmed nor denied the equity mood. Taken together, today's cross-asset picture was not cleanly risk-on or risk-off. It was something in between, cautious, watchful, and waiting. Which brings us to the headlines that shaped the session. The dominant theme coming into this week was earnings. We are entering the heart of first quarter earnings season, and the market knows it. One headline framed it well: record high stocks bracing for a first quarter earnings test. That framing is exactly right. When you are trading at all-time highs, every earnings report becomes a referendum on whether valuations are justified. One miss from a major name can ripple quickly through sentiment, and the VIX is already telling us that options traders are paying up slightly for protection. And behind that earnings, anxiety, geopolitical tensions re-entered the conversation today. A headline from Schaefer's Investment Research flagged that the Nasdaq's recent win streak is in danger as geopolitical pressures return. That is not a specific event. It is a mood, and moods matter in volatility pricing. When traders are uncertain about the macro backdrop, they buy puts. When they buy puts, the VIX rises. Today's 4% VIX jump is consistent with exactly that dynamic. Which brings me to the FOMO reversal story. Seeking Alpha flagged that S&P 500 options positioning reversed today as FOMO. Fear of missing out set in. This is a nuanced signal. When retail and institutional money chases a rally into record highs, positioning becomes crowded, and crowded positioning is fragile. The reversal in options flow suggests some of that chase money started hedging, quietly but noticeably. Meanwhile, the macro calendar for this week is the board we are playing on, and it is a significant one. We have a Federal Reserve speech from Governor Waller coming up, and more critically, a Fed interest rate decision on the calendar this week. These are the data points that can move the VIX significantly in either direction. If the Fed signals patience, volatility could compress. If the language turns hawkish or the vote is closer than expected, we could see a quick spike above 20. Keep that threshold in mind all week. Tesla earnings are also on the radar, a name with enough market weight to shift the index mood on its own. Taken together, today's headlines told the story of a market that is confident enough to hold record highs, but cautious enough to start paying for insurance. That is precisely the environment where discipline in entry criteria earns its keep. Now let's look beneath the surface at volatility. The VIX at 19.13 is elevated. Not alarming, but elevated. It is sitting in what we call the caution zone, between 15 and 20, above its 5-day average, trending higher on the day. The trend verdict from our system is rising, and that carries a bearish flag for income strategies like iron condors, which prefer a calm or declining volatility environment. The 10-day historical volatility, how much the S&P has actually moved in recent sessions, came in at 11.79%. That is the realized volatility. Compare that to the VIX at 19.13, which represents implied or expected volatility. The gap between those two numbers, realized well below implied, is actually constructive for premium sellers. It means the market is paying more for protection than recent actual movement would justify. That gap is where income strategies live. Now, the expected daily range indicator, our EDR. This is one of our two primary entry gates. Today's EDR came in at 1.39%, just below the critical 1.5% threshold that would trigger a hold. Gate met. The EDR temporal reading, which looks at forward volatility expectations, came in at 5.06%, well above its threshold of 0.94%. That elevated temporal reading is why our theta time shift system is pointing toward a forward roll, extending duration to 7 days to capture additional vega, that is volatility premium, in the range of 45 to 80 cents per contract. Now, the strategy insight for today. Both entry gates opened this morning. The EDR was below threshold. The VIX was below 20. The decision is place. Let me walk through what had to be true for that to happen. Because a place signal is not automatic. It is earned. The VIX needed to be at or below 20. Check. 19.13. The ATR to SPX ratio needed to be below 1.5%. Check. 1.39%. Both conditions true simultaneously. That is when the system says the environment is acceptable for structured income trades. VIX at 19.13. Elevated but still below 20. Conservative tier is green. Safe to place. Balanced is yellow. Tradable, but sized down if you are cautious. Aggressive is red today. Blocked per our VIX rules. We do not push the aggressive button when volatility is running this hot. For educational reference, here is what the structures look like at today's levels. The conservative iron condor, the widest, most defended setup, uses strikes at 69.80 and 69.85 on the put side and 72.65 and 72.70 on the call side for a net credit of 65 cents. Max loss on that structure is $435 per contract, with a risk-reward ratio of about 6.7 to 1. The balanced tier tightens the wings slightly. Put strikes at 70.15 and 70.20. Call strikes at 72.35 and 72.40, generating a net credit of $1.10, with a max loss of $390 and a risk-reward of 3.5 to 1. The aggressive tier is not active today. The rules said no, and that is the discipline. On the hedge side, the ALVH protection system, which stands for Active Layered Volatility Hedge, all three layers are live today. Short-term Spike Guard, medium-term VIXShield, and long-term Endurance Hedge, all three active. In a week where the Fed is speaking and earnings season is accelerating, having all three layers engaged is not paranoia. It is preparation. The annual cost of that hedge structure runs roughly 1 to 2% of account value, somewhere between $250 and $500 per year, and it is designed to offset 30 to 50% of iron Condor losses in a 10% plus S&P drop. That is the insurance premium. Today, it is fully in force. Here is the discipline lesson from today. The VIX rose 4% on a Monday. Earnings season is opening. The Fed is on the calendar, and yet the entry gate said place. Not aggressively, not recklessly, but within the rules, with the conservative tier green and balanced yellow, the system gave a clear signal. The lesson is this: discipline does not mean waiting for perfect conditions. It means trusting the rules you built before the pressure started. Today was not a perfect volatility environment. 19.13 is not 15, but it was within the defined parameters. And the defined parameters exist precisely so that emotion does not make the decision. Looking ahead to the rest of this week, watch the VIX closely around the Fed Waller speech and the interest rate decision. If the VIX crosses 20 and stays there, the system will move to a hold posture. Watch Tesla earnings. A significant miss or beat could shift the index mood and reprice volatility quickly. And keep an eye on crude oil. A 5% single session drop is worth monitoring for follow-through. Energy weakness can sometimes be an early signal of broader growth concerns. The execution window for today's signal, as always, was 3:05 to 3:15 in the afternoon, Central Time. If you were watching, that window opened cleanly. If you found today's summary valuable, share it with a friend. Both of you will receive 14 extra days of free trial access to the full VIXShield podcast and signals. Your personal share link is waiting for you in your member dashboard. This market summary is brought to you by VIXShield, your protection against daily uncertainty. Thank you for spending part of your Monday evening with us. A new week is open. The board is set, and the discipline holds. We will be back tomorrow. Same time, same framework, new data. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. This market recap is for informational purposes only. Today's VIXShield signal data is provided to illustrate the methodology described in the SPX Mastery Book series. This is not a trade recommendation. Review all risk disclosures at VIXShield.com/disclaimer before trading. This is VIXShield, your daily protection against market uncertainty.